Hi, everyone. Welcome to Retire with Style. I'm Wade. I'm here with my co host, Alex. And we're joined by a very special guest today, actually, one of the key thought leaders in the whole retirement income space, William Bengen. He is an MIT aerospace engineer turned financial planner turned retirement researcher. He's the individual that really modernized the whole world of retirement income planning in the financial planning profession by pointing out the idea that market volatility matters when you're taking distributions from the portfolio. He's done a lot of research over the years. His original article that created something that we'll be talking about, the 4% rule concept, came out in 1994. He wrote a book in 2006. I've used that book quite a bit, so much that actually the pages are following out. And that book's now 19 years old, but so you don't need it anymore because there's now an updated and much expanded A Richer Retirement, supercharging the 4% rule to spend more and enjoy more in retirement. And William Bengen is here with us today to talk about A Richer Retirement. His new book, available at leading book retailers, Amazon, or wherever else you might want to have a look. Welcome to the show, Bill.
Thanks for inviting me. I'm looking forward to it, Wade.
Yeah, great. And to get started, just going back to the early 1990s, because this was one of the things that sometimes I've tried to write about that era, but I wasn't really around doing retirement research at that time. So it's the early 1990s. People are asking you about retirement spending. You kind of survey what's out there. What led to the idea to actually, and what kind of research did you do that really countered some of the ideas out there about just assuming average rates of return and whatnot? What was that all about?
You're correct. I had a lot of baby boomer clients. I'm a baby boomer, and they were all just beginning to think about retirement. And they all knew that they faced something that no one prior had faced, where they could have as long as 20 or 30 years or more in retirement. That was not the case, as you know, let's say 70 or 80 years ago, where people perhaps would retire at 65 and then live 10 years. And there wasn't much concern about spending your money then. But for the baby boomers, it was clearly an issue. And I did my best to locate information about the topic. I would have loved if someone else had done the work and I was just able to use it for my clients, but I couldn't find anything. I think it's because the whole issue is so new, pretty much. So I decided to fire up my Lotus 123 and get a book of returns and inflation numbers and get to work, try to figure out what it's all about.
All right.
Well, Bill, I'd like to thank, as an advisor, I'd like to thank you for doing the work. You saved me countless hours. I'm teasing. On the shoulders of giants, as they say.
Okay.
And that approach, if you could expand a little bit more in terms of, I think what you might have been reading in the popular media at the time was, say, the S&P 500 averages 7% after inflation. So 7% is a safe withdrawal rate. And then that's kind of the starting base where you said, wait a minute, that doesn't sound right.
Yeah, well, that turned it up not to stand up to scrutiny because of the effects of bear markets early in retirement, which can deplete your portfolio at the same time you're drawing money from it and really reduce the withdrawal rate. So it's what they call a sequence of returns. Depends upon what your luck is like when you retire. If you get a bunch of good years to start your retirement, you're probably in clover. But if you hit an early bear market, you may have to pull in your horns a little bit.
Okay, and that's the origin of this idea of the 4% rule. I know you talk about in the book. So originally with that initial research, it was more like 4.2 instead of 4.
That's right.
Then later you added small cap stocks and it was more like the 4.5% rule. In the new book, it's the 4.7% rule. And there's a set of assumptions that go with that. So it would, I think, helpful just at the beginning to kind of walk through what are the assumptions or what are those key elements that lead to any one of these numbers that I just mentioned.
Yeah, I've identified 8 of them. There may be more, but these are the ones that I'm aware of now. Beginning with first the withdrawal scheme, which is just a mathematical rule you use to determine how much money you take out each year. It could be something like Social Security, where you start with a certain percentage of the portfolio the first year, and then just give yourself a cost of living adjustment for succeeding years. But there are a lot of options. You could take out a fixed percentage. You could take out a fixed dollar amount. You can take more earlier, take more later, infinite varieties. So that's an important thing to define. The second one will be the planning horizon, which shouldn't be confused with your life expectancy. The planning horizon is basically the length of time over which you want to be sure that you're going to be able to draw income from your portfolio. And for that reason, I recommend people start with a life expectancy and add 30 or 40% at least. So if you have a 30-year life expectancy, you'll probably plan for a 40-year retirement. That gives you a margin of safety because we're pretty tough pinning the date of death. Type of account, whether you draw from a taxable account or a tax-deferred account like an IRA, makes a big difference. Taxable accounts, of course, have to pay taxes on their accumulated capital appreciation and their interest and dividends. And ultimately, that results in a lower withdrawal rate. Although, if you look at it net, if you look at an IRA and when you remove money, you're going to have to pay taxes on it. You already pay taxes as you go with a taxable account. They're probably pretty close to the net after in both cases. The fourth element would be if you want to leave money to heirs. If you want to have a non-zero balance in your account, 50,000, 100,000, whatever you want, that's going to affect the withdrawal rate substantially. Element 5, asset allocation, probably the most complex topic because there's so many variations. Can you have a fixed variation? Can you vary it during retirement? I know Wade, you and Michael Kitces have developed that rising equity glide path concept, which I find very useful. So you have to define your asset allocation, and important to have a significant percentage of stocks in your portfolio, or else you won't have enough to generate meaningful withdrawals. The sixth element would be how often you rebalance your portfolio, which means how often you bring the portfolio back to its original percentage allocations for each asset. A year appears to be optimal, although it varies from retiree to retiree. The seventh element, next to last here, is are you satisfied with obtaining returns that are essentially index returns, as you would, let's say, from a passively managed fund? Or are you going to try and beat the market? Good luck on that, but there are some people that have been successful. And obviously, if you can earn superior returns, you will also raise your withdrawal rate significantly. And the last one is withdrawal timing, which probably is minor compared to all the others. If you take your money out all at the beginning of the year, you'll have one withdrawal rate. If you take it all out at the end of the year, you'll have a much higher withdrawal rate. Most people are somewhere in between. They take out money evenly during retirement, monthly, quarterly, whatever that may be. And my research is based upon the concept of evenly spaced withdrawals.
Okay. Yeah. So to review that, just so that 4%, 4.7% number that we're talking about, it's your withdrawals adjust for inflation throughout retirement. It's planning for a 30-year retirement. Money coming from a tax-advantaged account. So if any taxes are due, it'd be out of the distribution, but not a taxable brokerage account. No legacy intentions. Asset allocation, 55% stocks, 40% intermediate-term government bonds, 5% treasuries. And then the stocks are divided equally between 5 different asset class categories: large cap, mid cap, small, micro, and then international. You rebalance annually. You don't assume higher than the market or lower than the market index returns, and withdrawals are spaced throughout the year. And you do also talk about, and I think this is where the conversation will be headed next in terms of all this, but like the inflation scenario or the inflation environment and the market valuation environment, and specifically that 4.7% distribution rate, you kind of indicate is in a high inflation, if you're starting retirement in a high inflation environment and a high stock market valuation environment. And I want to unpack that a little bit with you, because I think as I was reading the book, to me, the biggest change I saw in the book was kind of this realization you had. Inflation may be the most important variable out there when it comes to understanding sustainable spending rates, more so than perhaps something like stock market valuation levels.
I have to agree with that. That conclusion surprised me. And up until the point where I concluded that it was best to treat inflation first, I was very puzzled about how to advise people on how much to withdraw from their accounts. But when you put the inflation first and sort all your data by inflation regime, all of a sudden the patterns emerge that can be used then to determine your withdrawal rate.
What kind of patterns for the everyday listener? Because one of the things when I'm listening to Wade and yourself speak, in my head I'm thinking, okay, inflation matters. Is there a line of demarcation with regards to inflation where it doesn't matter, maybe it matters? Okay, at this level it really matters.
Well, certainly high inflation, which I define as 5% or above.
Okay.
But then there's the other side, deflation, which we're not likely to have anytime soon, but that can have a very beneficial effect, as it did in the 1930s when people were faced with a 90% stock market decline, but they still could take out 5.75% because deflation for 3, 4, 5 years in a row allowed them to reduce their withdrawals, which partly offset the huge declines in stocks.
Yeah, bonds did quite well during the Great Depression. I wrote down a quote from your book because I thought this was really powerful. High inflation is the retiree's great enemy, perhaps more so than the feared stock bear market. Bear markets are painful, but a recovery always follows them. Sustained inflation is even more painful because it elevates withdrawals permanently. That quote really helped me because I've always struggled with the idea of, if we're talking about real rates of return, you've taken inflation out of them. So how can inflation matter? But it makes sense now. Like, whatever, suppose you get a real return of 0. Well, if your portfolio stayed flat, if inflation's 0, you have the same current withdrawal rate in the following year. If inflation was 10%, your current withdrawal rate goes up by 10%. Yeah. And that really can get you in a downward spiral.
So it's locked in. I mean, it's not likely to be a deflationary event to succeed that,
Right, it's a permanent
inflation. Maybe more subdued inflation, but it's painful, very painful.
And that was a big part of those 1960 era retirements that gave us that universal safe max, the lowest spending number. It was that high inflation coupled with high stock market valuations.
I think in those days, through the end of the 70s, portfolios lost about 75% of their real value. Partly because of inflation, partly because of the negative stock market action.
Okay. Now, in that regard, so inflation now, I'm comfortable saying it would be in your moderate category. That's the expected kind of inflation of 2.5% to 5%. And you create tables showing how in that moderate inflation environment, how the withdrawal rate relates to the price earnings, cyclically adjusted price earnings ratio, which is the ratio of the stock price to the real earnings averaged over the previous 10 years. That's been an interesting variable in past research because there is that relationship. Higher valuations tend to lead to lower stock returns and lower sustainable spending rates. But these days, those CAPE ratios are a lot higher than they were. One thing you note in the book, we don't really know what the withdrawal rate is going to be after about 1995 at this point, because you need 30 years of data. We are getting pretty far into some of the retirements shortly after that. But in that historical data where we know the 30-year sustainable spending rates, those tables that you create don't really go above a price earnings ratio of 24. And right now we're more at 38 or 39. How do you think about that issue of being outside of the range of historical data?
Sure. I realized that was a problem because that's where we are right now. And you couldn't use my research unless you had some kind of a applicable Shiller CAPE. What I did do is I went back to the research and I extended portfolios to 2015. So they each have at least 10 years of real data, which is usually sufficient to determine the sustainability of the portfolio. And when I did that, I was able to create a curve which showed the effect of very high Shiller CAPEs on withdrawal rates. And the nice conclusion is that a very large increase in Shiller CAPE does not mean you get a commensurately large increase in withdrawal rates. It may be very small. It's like asymptotic, almost reaches a floor. And that's really good news. So if the CAPE goes to 100, I'm not going to lose sleep over it.
Yeah, so maybe just take a little bit of a haircut. But that's kind of been the issue we've struggled with ever since it was the late 1990s when Robert Shiller came out with that research pointing out that inverse relationship between market returns and the CAPE ratio. Since then, the CAPE ratio has just been going higher and higher, and we haven't
Yeah,
seen
that was a great insight too. That connection between CAPE and withdrawal rates. It just turned out by itself to be insufficient to be able to use it as a tool, to get at those particular high withdrawal rates you'd like to. So it needed that extra thing, and that turned out to be inflation.
Gotcha.
Yeah, and that's the saving grace of, like, say, the retiree from the year 2000. They retired at the highest peak for the CAPE ratio, but because they had low inflation, probably the 4% rule is going to end up being fine. We're almost at the end of 30 years, or 5 more years, I guess. But
And just to reiterate, just some folks may be listening in, the key here, and I'm going to reiterate it. The key here is effectively inflation is the key, because regardless of the valuation, it's just not enough to kind of move the needle as much as inflation, because once that train takes off, you're going to be adjusting that amount, that nominal amount for inflation year after year after year after year. Hence, there's that creep. If that creep never occurs, you can baseline it and you should be okay. And I say that in air quotes. That a correct regurgitation?
Yeah, I think so. As Wade indicated earlier, that stock market, bear markets can be damaging, but because there's a recovery following these markets,
Exactly.
throw you off plan. If you look at it from a longer term point of view, short term it'll look awful. You may have a withdrawal rate of 1% when you start out at 5, but if it's a normal stock market recovery, it'll come back within 4 or 5 years.
Yeah, and if you have, let's say, a zero market return over the next 5 years, but inflation is 7%, you're actually getting hit. You're increasing withdrawals every year, 7%, 7%, 7%. Now, mind you, yes, in reality, people may adjust accordingly, but per the rules, that's going to get you.
Exactly, and that's why the worst case scenario, the 4.7% rule, was based upon the person who retired in October of 1968, because they were followed by 2 huge bear markets and then a decade of high inflation, and it was just devastating.
Now, in terms of the ways people might misinterpret things, even though you kind of mentioned that it's your universal safe max is 4.7, you don't necessarily think that's the rate people should be using all the time, even with those 8 elements that we talked about being the same, because we're not necessarily in a high inflation environment. We are in a high stock market valuation environment, but not high inflation environment. So what is a reasonable withdrawal rate today in terms of, with otherwise using those same basic elements we discussed?
Yeah, it appears to me that about 5.5% versus 4.7% should be okay. I'm always a little leery about those high Shiller capes, because we really don't have a lot of data points for Shiller capes that high. And we don't have, a full 30 years for anybody with a very high Shiller cape. So take it with a grain of salt, but I think 5.5% is reasonable. You can't really compare the circumstances we face today with people did in the late 60s. We're not faced, hopefully, with this massive inflation wave coming. And although we may get a bear market, hopefully we'll ride through that and get to the other side.
I got you. And wait, another thing while he was speaking made me think, because you guys are talking about the Case Shiller and all that, but in the portfolio, you have a healthy asset allocation beyond just large cap US.
That's right.
And so, really, yes, the S&P is, considering them the top 4 stocks, there is a valuation peak if you include those because they're in there. But when you're talking about micro caps, as you said, small caps and the like, I don't know off the top of my head what those valuations are, but by no means would I call them excessive, especially based on the last, 5-10 years of performance.
Yeah, I think the only thing I would mention from what I did in my book, I think I primarily focused on a 55% stock, 40% bond, 5% cash portfolio.
Yeah.
I've been doing some research with a 65% stock allocation, taking 10% out of bonds, and it significantly improves withdrawal rate. Not across the board. There is a small number of investors who have the bear market, early retirement. They'll lose a little bit more than they might with a 50%, 55% allocation. But the rest of the other 80% of the investors pick up almost 50 basis points on average, which is pretty significant.
Yeah, as a percentage, that is significant. As a percentage of the distribution, yeah, someone may think 50 bips is nothing, but as a percent of, 50 bips on 4% is over 10%. It is significant.
Yeah, it is. So I'm probably going to be switching to that as my favorite portfolio, although I'm going to continue to look at higher stock allocations. I read a report once that suggested that 100% stocks in all parts of your life cycle, including retirement, is best. I don't know if I agree with that, but I'm going to take a look at it.
There are reports like that come out every few years, it seems.
Just because I do have a question then, and this is a Wade Bill question where you guys can ask, but from Wade's stuff as well, I come across from that thinking that maybe sometimes we split hairs too much on the stock to bond, and by that I mean 50% versus 53% versus 47% in equities versus the inverse being the opposite being fixed income. But to me, it seems you could get there kind of with a nice window range of stock to equity allocations. Like you can have a successful investment experience from a withdrawal standpoint, if you're within just a certain range as opposed to this magical number. Am I off on that?
Yeah, I think so. Although I think you may want to tilt it to the higher end based on my research, but I agree with that. There's a point, a plateau obviously in the charts where it doesn't make much difference to withdrawal rate what your stock allocation is, as long as it's in that zone you mentioned.
Yeah, I think you showed with the preferred allocations in the book that between 45 and 75% stocks.
Yeah,
it's about the same worst case scenario. But if you're not the worst case scenario, the higher the stock allocation, the better off you are.
Yeah, well, some of those charts I looked at more successful retirees, and 95% stocks was clearly indicated as the best allocation fixed to retirement. So that's been leading me to explore higher allocations.
Okay. Now, when I think about kind of the stock allocations in general, I usually approach it more from a market cap weighted, like a total market portfolio. I don't even know what micro cap stocks would be in that, but maybe a percentage or two. International would probably be more like a third, US 2/3, but then primarily large cap. Are you comfortable, or do you use yourself this idea of equally weighting between those different indices so that you really do get a dramatic overweighting? I think especially in the micro cap, but between micro cap and small cap, mid cap.
Yeah, I'm comfortable with it. I think you could even probably emphasize the allocations to micro caps and small caps a little bit more. But you have to be careful, because we don't never ever know where the returns are going to come from over the next decade. For the last decade, it's been all large cap U.S. stocks. Will the next decade look like it? I doubt it. It'll probably be something else. So that's why the diversified portfolio is important. And I keep the allocations equal, because I don't know which will outperform in the future.
Okay. And you mentioned the rising equity glide path idea. Thank you. I read the book yet. You kind of mentioned myself and Michael Kitces on that. I guess another kind of idea related to that is you mentioned then there's 4 free lunches available to investors: diversification, rebalancing, actually what we were just discussing with the tilting towards the smaller cap sizes, and then the rising equity glide path. Could you talk a little bit more about that, like these 4 kind of ideas that you see as the best way to really help build a stronger, sustainable?
The whole focus of my research is to find a way to get people higher safe withdrawal rates without taking any additional investment risk. So the free lunches satisfy that criteria. Asset allocation and a frequent rebalancing, kind of a standard practice in the money management industry. So that's really no surprise. Rising glide path, is kind of a neat idea. And I'd like to do more work with that to understand it better. And having an allocation slightly tilted to other higher performing assets may work out as well without creating risk. Although the whole small cap arena, people have been talking about this lately. I have to agree with them that small caps may not produce returns they have in the past because a lot of the best companies are going now to venture capital and private equity and never make it to the funds. And a lot of the index funds that we do use for small caps include a lot of companies that will never make money, have never made money, will never make money. So in the small cap area, you may have to change the strategy. I still think it's worthwhile. I suspect they're going to do much better in the future, but you may want to look at a rather than an index fund, an actively managed fund that picks out the best companies.
Well, I would say there's been a lot of I don't know if you're focused just on distributions, but there would be an argument to be made by quite a few saying that there really isn't as much of a small cap premium as previously thought, and it has more to do with like a blend of profitability within the small cap area. And if you focus on that sort of profitability and value within the small and micro, that's where the premium would be. But even if there's not a premium, I would imagine from a correlational effect of putting a portfolio together, you're still going to get market rates of return. And if they happen at different times, the portfolio would be better off for it.
Yeah, I think so. I'm not ready to give up on small caps yet.
No, I'm just kind of giving you that
right.
sort of.
You're right. Yeah, I think they're going to have a run here, but we'll see.
Here we go.
And with the rising equity glide path idea, the idea of increasing your stock allocation throughout retirement to help manage sequence risk. You even mentioned the 4.7% rule becomes the 4.8% rule.
Yeah. It could be. My research still understates probably the true withdrawal rate slightly because I have only 7 assets in my portfolio, and that's hardly a diversified portfolio in today's terms. I don't have any REITs, don't have any gold, precious metals, commodities, alternative investments, tips. All of those could make meaningful contributions to a portfolio. So I'm, in my own mind, when I think 4.7%, I'm thinking it's probably really 5, but we'll see.
No, and if you throw in Onus Wagner rookie card, take it to 6.
There we go. Yeah. I got 3 of those, all graded. Yeah.
PSA 10.
There we go.
So what do you kind of see as the most important takeaways or ideas for readers of the book? And again, we are talking about a richer retirement, supercharging the 4% rule to spend more and enjoy more.
Yeah, I think that rather than an immediate search for a number, a withdrawal rate, it should be considered a process to develop a withdrawal plan. And the steps you need to follow, including identifying the 8 elements and then determining where you are with respect to inflation and market valuation, and then putting them all together to find out what your withdrawal rate finally should be. So the withdrawal rate is one of the last things that come out of this process.
So maybe another way of asking a similar thing, but I think it's worth positioning it this way for consumers, is sometimes people get too reductive. And they would say, well, I got this retirement income planning thing down. I'll just take out 4% from my portfolio and call it a day, and I'm good because look at all the research. It's become like a rule of thumb to some extent. What would you say to someone that just says, hey, yeah, I just take out 4% and I'm good to go?
Well, I think you're going to be a very rich person when you're 100 years old. Probably a lot richer than you really want to be.
There you go. Okay.
Because if the money is not going to withdrawals, it's going to portfolio growth. And, you have to make a decision in your mind. Are you comfortable with having a huge balance in your retirement account at the end, or are you going to have regrets of not having spent more of that earlier? So that's what my work is, to help people find ways to spend more and do so as safely as possible.
Okay. Now, are there still areas that you're kind of interested in researching further? Like if you're going to create another edition of the book, what else out there is on your mind in terms of things worth exploring?
Yeah, great question. I think my research list is longer than it's ever been. And after 30 years, I'm really surprised by that. I want to learn more about high stock allocations and their effect on withdrawal rates. I want to study that rising equity glide path more completely. I'd like to take a look at some of those alternative withdrawal schemes like a fixed percentage and do a more thorough analysis of that. there are just so many topics. I've got a list of them somewhere, but I'm not going to have any shortage of work.
Sure.
Retirement, so-called retirement.
What on that vein, what's your take on if you've thought about it, lumpy distributions, not necessarily a steady 4%, but knowing that as people get older, they're less inclined maybe to spend as much because they're just not doing as many things, that kind of thing, where it sort of is a lot at the beginning, then less, let's say 15 years in, and then, pops up at the end. How do you conceptualize that, if at all, in your research or thinking about how to arrange a research agenda around that?
Sure. That's what I consider a withdrawal scheme, a mathematical definition of how you take money out. Taking more money earlier and less later is perfectly legitimate. And I've analyzed that, I think, in some detail in my book, and came to the conclusion that it's workable, but you have to be prepared for a very significant cliff or drop in expenses. And let's say year 11, you're going to spend high at the first 10 years and then lower at it could be 10, could be 20, could be 30% reduction in expenses. That may be perfectly okay, but you need to be prepared for it.
Yeah, you talked about there's almost like a rule of thumb there where if you want to raise the withdrawal rate, say 10% more spending in the first 10 years, the rule of thumb was you have to then have a 20% drop after that. Is that
probably pretty fair? Yeah.
Now, most of the research you did during your working years, you subsequently did retire yourself, and now writing this book is part of retirement. Did you kind of take away any lessons from the whole process of actually retiring and then revisiting the research again from the post-retirement perspective compared to the pre-retirement phase?
Well, one thing I learned, I started out back in 2013 taking out what it then was the 4.5% rule. And the stock market has been so strong since then that, I've built up more wealth than I feel comfortable doing, the need for it.
Congratulations.
I'm just spending like crazy. No, it just increased it, particularly gifting to my children, which is important for me.
Gotcha.
My dad did. And it's nice to see young people enjoy the money while you're still alive.
And the new tax legislation raised those limits for the estate taxes, so that may help too.
Yeah, there we go.
So we are going to have Bill join us again if you're listening to this more or less live. We're actually recording the day before this episode comes out on September 9th. On September 11th, 2025, we'll have a live YouTube Q&A where you can ask Bill questions that you have. So we definitely are looking forward to getting many more questions. But just for today, at least, any kind of last parting thoughts in terms of, again, if folks want to read A Richer Retirement, Supercharging the 4% Rule to Spend More and Enjoy More, I think probably the answer is just check it, your favorite book retailer. They probably have it in stock or can get it ordered for you. And any last thoughts in that regard?
Just that once you develop a plan, it's like any other long-range plan. It needs to be continually monitored during retirement and possibly adjusted if circumstances warrant it.
Mm-hmm. Yeah, that's a great point. And that's, I think, in terms of how people might misinterpret the research, it wasn't really meant to be set it and forget it, where you develop your withdrawal strategy in year one and never revisit it again.
So in that vein again, then, Bill, since we have you, what would you say someone's going through their process and they're year 7 into their distribution scheme and COVID hits? And I use COVID because it's an easy kind of, it's still relatively recent, and it was one of these what now moments as opposed to just carry on. That was a significant moment that gives everyone pause for reflection or pause for let me take a step back. And considering, they've been following the rules and so forth, something seismic like that comes where it looks like it could be, fundamentally changing things. How would you, what advice would you give to people during moments like this? And we didn't have something along the lines of COVID, but every 2 years there's something. Like we had the tariff stuff in April where it was like, oh my goodness, market drops 20% in a few days. What's going to happen now? Because we always have that. And to your point at the beginning, markets recover, et cetera, et cetera. We get that. But when you're in the moment, it's one of those things. What advice would you give to somebody like that who's trying to follow these guardrail rules that you have?
Well, I think it's good to have a third party to talk to if you get nervous about things. When the market's down 25, 30%, it can be pretty painful and pretty worrisome. So if you can't handle that yourself, rather than damage yourself by pulling out of the market at probably the wrong time, find an advisor, a third party, somebody who can talk to you about this and perhaps calm your fears and keep you on plan.
Great. So thank you so much for joining us. And let me emphasize again, if you have questions that you'd like to ask the founder, the father of the 4% rule, really the father of retirement income planning as we know it today, we're going to be on YouTube Live on September 11th, 2025, in case you're watching this well into the future, at, I don't have the time, 1 p.m. Eastern time. You can find instructions on how to join that YouTube Live session in the show notes for this podcast. It's 2 days after the podcast is released. Any questions that you have, this is your opportunity. And again, Bill, thank you so much for joining us. And if people do want to keep track with your work and with all the revised findings and updates to the research that you've done, it's A Richer Retirement, available at book retailers of your choice.
My pleasure, and I look forward to talking to you on the 11th.
All right.
Hi, Bill. Thank you so much.
Thanks. Bye-bye.
Thank you, Bill. And thanks, everyone, for listening to Retire with Style.